All right, good morning, folks. Tim Davis coming to you guys with a midweek market review. We're a little past Wednesday, but it is before the opening bell on Thursday morning. You guys know that I do a lot of these recordings late at night just because of where my schedule is, or early in the morning just because of where my schedule is. So the time is now 2:40 a.m. Eastern Standard Time. Today is now March 16th, 2023. This video may be a little long because I want to completely break down what we're seeing throughout the market from a technical standpoint. So I'll be looking at different time frames. I'll be looking at all the major indices. We're taking a look at the metals. We're taking a look at a lot of various time frames and technical setups, so you guys can get a full picture of what the markets are showing us. And just to start off, I'm gonna let you guys know now, from what I see, it looks like the bears are in full control of this market now. They're in the driver's seat in a major way. So with that said, I think that any rallies we see until this market really formulates or establishes a strong level of support, that any rallies we see, especially the short-term rallies, I think they'll quickly be sold off. I think the only saving grace to this market right now, we have to see what happens between now and next week, but the Fed meeting is on next Wednesday. They're either going to try to this next Tuesday or next Wednesday. I'm not sure. I gotta look at that. But they're either the Fed speak is either going to put a pause to what's happening in this market, try to be this market's saving grace, or it's going to find a way to not just put a pause, but it's going to find a way. Fed results will find a way to allow this market to rally out of this spiral that it's at right now, or it could send it into a deeper spiral to get the pain out of the way rather quickly. But needless to say, nevertheless, regardless of what happened, let me show you what the technicals is showing us, what the setup is showing us right now. By first of all, taking a look at the longer term monthly charts and the SPXA 200R. So you guys know who've been paying attention to me for a while that I like using this tool. It's pretty much a overall market sentiment tool. It tracks the percentage of S&P 500 companies that are trading above their simple 200-day moving average. And by looking at the monthly chart, it's giving me a broader perspective of what the bigger picture looks like, what the longer-term outlook looks like as far as our overall market sentiment goes. So looking at this tool now, I'm going to go back first and show you guys what it looked like in 2008 and what we are seeing now. So back around 2008, and I keep referencing 2008 because I think that's what the setup, that's what I see right now. It looks like we are showing signs of the 2008 move all over again, if not worse. So that's why I keep prefacing the 2008 time frame. So in 2008, and what I'm going to point out here, folks, is I'm going to show you guys what's happening by using moving averages, since a lot of folks like to use moving averages. And on my chart right now, I'll be referencing some time frames, maybe all time frames, by looking at the major moving averages. Then I'm gonna clean up the chart a little bit to show you guys specific pivot points and support resistance levels on a cleaner version. But this yellow line that you see on my screen right now that's my 20-period moving average. The light blue line is a 50-period moving average, and then once we get to a red line, that'll be a 200-day moving average, simple moving average, moving line. I mean, yeah. So if we look back around 2007, 2008, we see that's when we started to descend. Overall sentiment of the market started to descend and become very negative. That descent went from 2007, as far as this particular tool, for 2007, pretty much all the way down to 2009. In somewhere in between, there were some small rallies, which is like I'm going to show you what we're showing here. Some small rallies, and in the midst of that, but each one of those rallies were met with strong reversals in the market. So that was the sentiment that was shown in 2007, 2008. It was a negative sentiment overall, with a few rallies in between, until we got to 2009, and then pretty much, if you were really aware back then and you got to spot pivot points, you would have saw this was a strong reversal here, by looking at the overall consolidation that was happening for several months, and then we pretty much just sentiment just took off to the upside. So that was the time, what was happening back then. Now, if you look at what some of the indicators were showing us, you can see right here, 2007, when this 20-period moving average has pretty much started to descend as well with the overall percentages, and you see that the 20-period moving average started acting as a level of resistance. So when we got those rallies, pretty much rally almost up to that 20-period moving average and continue to reverse there. That around 2007, 2008 did the same thing. Somewhere in 2008, same thing up to that 20-period moving average and reverse. And then when there was a large gap in between the percentage, and they started to see this large gap in between the percentages and the 20-period moving average, that was a sign that overall sentiment was probably hitting capitulation. Got the big gap in there, and all of a sudden, 2009 started to ramp up, run into the 20-period moving average and break right through it. If you know, the 20-period moving average started to bend, started to turn back up, showing you that you pretty much, after this big gap in between the percentages and the 20-period moving average was filled, 20-period moving average started to turn up. That was a confirmation that we broke through it, that the overall sentiment was turning from a bearish narrative to a bullish narrative. So that was the look from 2007 to 2008. Again, folks, we are reviewing right now a monthly chart, which when I see major moves in the market, I like to pay attention to the longer term time frames, because they're going to run and supersede the shorter term time frames. Now, here's where we are now. So we started this descent in overall sentiment actually back in 2021. So in 2021, even though a lot of stocks were still, making the bulls a little happy, the overall sentiment was changing. We got to as high as 97% of the S&P 500 companies trading above their 20 moving average. That sentiment started to quickly reverse on 2021, all the way until we got into about October of 2022. Then we saw a reversal to the upside. One thing I'm going to point out, we saw this reversal to the upside. A lot of folks think, okay, things are good in the bull market. Let's see this thing run. Not so fast. So as we started to see sentiment shift, and as I showed you in 2008, 2009, after that time frame, was it just a bull rally within a bear market? And that's when I was led to believe that that's all this was. It was just a little longer term bull rally within a bear market, because the sentiment went all the way back up, where to this red line, which is my 200-day moving average, and was halted in a major way. There were signs that were probably, that's probably what we were possibly in store for, because there was a crossover with the moving averages, and I pay attention to crossovers in a big way. On a monthly chart, we started to see a crossover right around between that July to October period, even though, like the sentiment was shifting from a bullish, from bearish narrative to the bullish narrative. The moving averages were given a different signal. So right around July, we had a crossover of the 20-period moving average below the 200-day, and as we continue to go throughout that year, last year, we had the 20-period moving average crossing below the 50-period moving average, and it continued its descent. Did not turn back up like we did in 2009. There was a gap in the market, gapping down between the price action and between the percentages and the moving averages, which would lead me to believe that this gap was going to be closed eventually, and that's what happened. The percentages started to move up. Sentiment started to become a little bit more positive, but the moving averages did not become positive. As you can see, as the percentages of stocks trading above the 200-day moving average was on the rise, the 20-period moving average continued to go lower and did not turn up like it did in 2009. So that led me to believe that this was pretty much just a bull rally within a bear market because the moving averages were just not agreeing to what was going on. So that said, 20-period moving average, as sentiment started to change, 20-period moving average continued to creep lower, lower, and lower. And then all of a sudden, eventually, percentage ran into a strong wall or a strong ceiling and could not break above that 200-day moving average. And that's where we stand now. And now, even with that, we're starting to get confirmation that the bears are ready to take back full control, because while overall sentiment was rising, ran into this strong wall of resistance, or this ceiling of resistance. 20-period moving average is still telling us not so fast. We're still in a bearish narrative. 20-period moving average continue to drop lower. Now the 20-period moving average trading below the 50-day and the 200-day. What I expect to see in the very near future, more likely, is we'll start to see some bending in these moving averages, the other moving averages, such as the 50-period moving average and the 200-day. Start to see those bend with the 20-period moving average on the bottom, which is where it is, the 50-period moving average in the middle, and the 200-day right above that. And as they start to bend together, that's just confirmation that the bears are just really starting to take full control of this market and send overall sentiment lower. So that said, the bears are definitely in control of the overall sentiment of this market. Now, back in 2021, we got to as high as 97% of stocks trading above that 200 moving average. As of yesterday, we are now sitting at 36. It's right here, 0.36% or 0.37%. Rounded off because it's 0.3698 of S&P 500 companies trading above that 200 moving average. That means it is below the 50% level, folks, and that is a big time bearish signal. So less than 50% of the S&P 500 companies are trading above that 200-day moving average, and that percentage is just dwindling week after week after week. So the bears are definitely in control of this market as we speak. All right. So now that I broke that down with what's going on with the SPXA, one more thing I'll point out is that more confirmation on this monthly chart. This is my oscillators and the Williams percentage are definitely trending downward. Oscillators and full stochastics is trending downward with a bearish crossover of the negative line and the positive line. Green line is a positive oscillator line within this full stochastics tool. It's crossed below that red line, which is definitely a negative narrative. So in addition to what I just showed you in the percentages, what the percentage indicators, the percentage candles are showing us, even in the indicators that I use to track market movement, full stochastics is showing a negative narrative in a major way, and RSI is trending lower. Right now, RSI on this monthly chart shows at 45. So oversold conditions are not normally until we get below 30 RSI. So overall market sentiment is negative. So when you see this overall market sentiment is negative, folks, that bleeds over into the major indices actual price action. So now let's flip to Dow Jones. We're paying attention to Oh, before I slip to the Dow Jones, let's go back to the SPXA 200R. Say 200R. So I took a look at the longer-term monthly chart. Let's take a look at I'm even go even a little deeper. Look at a 4-hour. No, that's not interesting. Let's look at a daily. Look at a weekly first. So here's a weekly chart of the SPXA. Look what's happening. The sentiment got above 200-day moving average and just started to quickly reverse. Now we're back below 200-day moving average again, which is my red line. Back below the 20-period moving average, which is the yellow line, and now we're back below the 50-day, and the 50-day is acting as a strong level of resistance and support because we broke back above this week with that long wick, but right now the body is still below this 20-period moving average. So my speculation is that this 50-period moving average is going to act as a strong level of resistance this week. By the end of the trading day on Friday, if the sentiment is not pushed back above the 50-day in a major way, this selling pressure is just going to continue, folks. So we'll start to see the sentiment drain, and the selling pressure in the major markets is going to continue to dwindle and drain as well. Almost in oversold territory in RSI, but not quite there, and I think we could see that happen. Look at a daily chart, and we are in oversold territory, but we could dwindle down there, folks. We could dwindle down there. It's a lot of indecision right around the 200-day moving average as we speak right now, because there's been so much selling going on. So it would not surprise me to see some type of rally, you know, or if sentiment change, not even or sentiment change, but would not, you know, surprise me to see a shift of overall sentiment temporarily, and we could see a little bounce here. And I do say a little bounce if that happens, because what has already happened, we have the moving average crossovers that are confirming the bearish narrative we have in this daily chart. We have the yellow line crossing below the 50-day moving average, and it's still trending lower until we see, you know, these moving averages bend back upward. No matter what rallies we see, they're going to be met with fierce resistance at these moving averages, because these moving averages will start to act as levels of resistance. Now there's a gap space in between the two. So what I do expect is they're going to find a way to meet. More than likely, we'll probably see these moving averages start to trend lower until they run into the price action or the percentage action and continue to push lower. So that's what the near-term action like to do percentages. Now, let's switch to Dow Jones futures. And here is where you can really see what's happening with actual price action. So this is Dow Jones futures. And this is a daily chart. Folks, look what's happening. We consolidated, but look where we're consolidating at, right below, just below 200-day moving average. That's where we're consolidating. So that 200-day moving average on a daily chart right now, then the day Dow Jones futures market, that 200-day moving average acting as a strong, and I do mean a strong level of fierce level of resistance after price action just over the past several days has dwindled, and fell below that level. That 200 days acting as a very, very strong level of resistance. As that's happening, look what's happening with the 200-day, the 20-period moving average. It has crossed below, perfect cross around March 6th. Lining this up with the dates at the bottom, as you see. So around March 6th, price action got a bounce around March 1st from its 200-day moving average, rallied up, but the narrative did not change, because this 20-period moving average continued to go lower and even cross below that 50-period moving average around March 1st. At the same time, price action started to go up. Price action started to go up, but the moving average did not. It continued to dwindle lower and cross below the 50-day moving average. So more than likely, what was going to happen once price action got up to that level, if the moving average didn't confirm the upward movement and start to turn up, then that means we was going to hit the level and go lower, which is what happened. That's exactly what happened, folks. So this level, or the 20-period moving average and the 50-period moving average, became a strong level of resistance, sending price action lower. And as you can see, 20-period moving average and the 50-day did not budge. 50-period moving average did not budge. They continue, 20-period continued to go lower. So now the 20-period moving average is going to act as a strong level of resistance on this daily chart. And look at the gap between the two as price action continued to roll over. But look what's not happening. Price action is not coming up to meet the moving averages. The moving averages is coming down. The 20-period moving average is coming down to meet price, and we almost hit it, almost to it. So what could happen? I think this 20-period is still going to act as a strong level of resistance. The bulls got full control of this market. So on this daily chart, I believe I'm looking at, bulls are definitely in full control. As the two start to meet, we're probably going to start to see another leg down if the price action cannot bump above this 20-period moving average and turn the moving average back up. I don't think that's going to happen. I think the bears are definitely back in the driver's seat in a major way. So I think eventually this consolidation is going to run out of steam, and we're probably going to see another leg lower in the near future. So that's where we stand on the daily chart of the Dow Jones. It's just hovering right around this 50-day moving average, just below it, as the moving averages as the 20-period continues to trickle lower. We'll start to see the 50-period start to bend as well. Now, if we see this 20-period trickle lower the next couple of days and drop below this 200-day, and that's going to be really detrimental. Then we'll probably start to see some major selling. So that means the 20-period moving average more than likely is going to become a strong level of resistance. So as price goes down, we'll start to see the 20-period start to bend, and then the 20-period moving average will either ride price down or create a gap in between the two with a major sell-off in price action. So that's what the technicals are showing us, folks, on this daily chart of the Dow Jones. Here's where we stand on the weekly chart. This Dow Jones futures. And I'm going to show you guys something that I pointed out probably about a week or so ago. It really caught my eye as it relates to the overall movement of this market. A weekly chart, it was definitely it was definitely something to keep an eye on. Definitely in my sight line of vision, because it ran into a strong level of resistance back in starting back in November of last year. Strong level of resistance that it was just bumping its head up again, and it just could not break free above that level. Then what happened? Now we're tipping lower, slowly but surely creeping below major moving averages, even on the weekly chart. So right now, price action is below the 50-period moving average on the weekly. I think that will continue to dwindle over the coming weeks. Now I'm gonna switch to a cleaner version of this chart just on the Dow Jones to put it in perspective. Put it in perspective as it relates to the time frame by looking at a monthly chart and a weekly chart, and put it in perspective as it relates to the pullback that we saw in 2020. So let me point that out. So here's a high of 2020. We hit that level. We were trading pretty much. You can see the 20-period moving average is acting as a strong level of support back then. We were trading well above that until around the beginning of 2020, and then we see what happened. Price action crashed below that 20-period moving average, and now it became a level of resistance until it broke back above it. This is a monthly chart we're looking at now, folks. Again, so this is a monthly chart. Now, look what's happening. Fast forward to what's happening now. So now, price action, got to its high right around beginning of 2022. Then price action started to dwindle lower. And look what price action did, drop below this 20-period moving average. So the 20-period moving average would eventually act as a level of resistance on this daily chart. Then what happened in October, and we see this diagonal line of support. We get a bounce from that level. Oops, let me do this. We get a bounce from that level back up to where? Horizontal diagonal line of resistance, as well as running right into that 20-period moving average, which also kept price action right around it, acting as a strong level of resistance. So now what's happening? That 20-period moving average is starting to take over price action. And we're starting to see price action trade back below the 20-period moving average on this monthly chart. That is very negative, folks, which leads me to believe that the next couple of months could be very, very dire for our markets. We could see price action head back down to this diagonal line of resistance in a major way. If that happens, that would also put us, get rid of this. Oops, didn't mean to do that. Get rid of that. That would also put us on track to start to drop below the highs of 2020, folks. So pay close attention to the Dow Jones. I think the Dow Jones is going to give us fair warning in advance before the S&P, before the NASDAQ, because it's extremely close to extremely close to the highs of 2020. We break below that level, you know, I feel sorry for any bulls in this market. Just put it to you that way. So we're really going to start to see some acceleration downward. So we're getting very close to that level. And if I had to put a price on that level, so when we see price drop below 30,000 in the Dow, we drop below 30,000 in the Dow, folks. I'm telling you now, we're going to probably really start to see the market give up the ghost in a major way. I mean, it's already giving up now, but we ain't seen nothing yet. If we drop below 30,000 in the Dow, it's going to be, you know, probably going to see capitulation start to happen very quickly. So just keep that in mind. 30,000 level is something to pay close attention to as we travel through the rest of this year. That's what it looks like on the weekly chart. I'm sorry, monthly chart. Rid of this. And for confirmation of the downtrend, and that's what we're definitely in now, folks. This is a downtrend, folks. There's no way to put it. We're in a downtrend, a strong downtrend in market. By looking at this monthly chart, and this downtrend could remain strong for quite some time now. Now, for confirmation, if you look at the full stochastics, starting to get a crossover of the green line crossing below the red line. And the full stochastics on the monthly chart, that is strictly negative. We're continuing to see the wins percentage oscillators point lower. And CCI, this is CCI now. I'm taking a look at CCI. It's getting ready to cross with a sell signal, which is what some people look at this as. When you have the green oscillator cross below the yellow, they consider that a strong sell signal bias. Same way with full stochastics, when you have the green crossing below, green oscillator crossing below the red one, they consider that a strong sell signal bias. So again, all is to show you guys different angles by taking a look at this market to show you that the bears are really sinking their teeth into this market. Now let's switch back to a weekly chart. Even though we see levels in the CCI that's starting to show us at the bottom that CCI is trying to is in oversold territory and maybe trying to turn up. I think that's just I like to pay attention to all the other indicators, because we could get a false sense of security by seeing oversold prices, and we think we're going to really ricochet to the upside. I don't think that's going to happen. I think we're going to continue to see price action under pressure. And I think we could stay in oversold territory in CCI probably for quite a bit, but that could change. So we have to see what happens. Do we get price action out of this oversold territory in the near term? We have to wait and see. But keep in mind, it's time frame looking at some weekly charts. So there's a wide divergence between the two oscillators within the CCI, meaning that we could see price action try to rally just a bit, but pay close attention to the other indicators and the actual price itself, because the 20-period moving average is now, even on this weekly chart, it's now starting to act as a strong level of resistance. We have price action dropping below the 20-period moving average for the first time in a while. We had not been below this 20-period moving average since September of last year. Now price action is starting to drop back below this 20-period moving average on the weekly chart, so that's going to act as a strong level of resistance. We'll probably start to see this 20-period moving average on this Dow Jones weekly chart continue to trickle lower, and we'll start to see price action run into that. Now, if we get a wide divergence between the two, first time we get a wide divergence, then I would definitely be looking for a snapback rally. But that will probably run into resistance again somewhere around the 20-period. So we have to see what happens. Right now, again, all this to show you guys how the bears are definitely still in full control of price action in this market. Again, on the weekly chart, we have the 20-period moving average now taking full control, with price action trading below the 20-period moving average, which is now going to act as a level of resistance. Look at the near-term chart by looking at the daily. So here is a 1-year daily chart. So we can really put it in perspective there as to what's happening. So we see how we started to really hit our head up against resistance just over the past several months. Back in November of last year, we hit resistance there. So this level up here has been a strong level of resistance until price action gave it the go, so we started trending lower. So now what's happening is just how price action was on the way up on this daily, as we had the price action trading above its 20-period moving average. Now look what's happening. The 20-period moving average is starting to bend lower on this daily chart, and it's acting as a strong level of resistance. As we see, price action tried to rally here and got stopped by the 20-period moving average. Now we're back here, and we're probably going to see the same type of scenario, stop, as we continue to trend lower. So on this daily chart, you can see that the 20-period moving average is pretty much riding price action lower, and it's going to continue to act as a level of resistance. So every rally we see, probably for a minute now, it's probably going to run into this 20-period moving average and continue to act as a level of resistance. See, nothing goes down in a straight line, so we'll probably just continue to see this action for quite a bit now. Who knows how long this will take before it finds a way to overtake the 20-period moving average. Right now, there's so many signals that's showing that this strong movement to the downside is probably going to remain here for a minute. So unless we break back above this 20-period moving average on a daily in a big way, probably going to continue to see these rallies be quickly sold off. All right, that's what our daily chart looks like. And even if you wanted to even get a little bit more, time oriented or near term oriented, even our 4-hour chart is showing a 20-period moving average riding price action lower. So even our 4-hour chart, we around the beginning of March, we got jumped above our 20-period moving average, but then blocked right back below it. And now you can see it's continuing to ride price lower past several days. hit this 20-period moving average and went lower, hit it here, went lower. And look what's happening right now on this 4-hour chart, which leads me to believe that the next day or so, it's going to be not good for the overall price action. So for the past several days, the 20-period on the 4 hours also been acting as a strong level of resistance. Right back at the 20-period moving average right now as we speak, and looks like it's ready to bump its head into that resistance and make another turn lower. Full stochastic showing you the same, like it's ready to go back lower again. CCI and Williams percentage all like it's ready to go lower. So we got to see what happens as we trade throughout the rest of this week. We still have 2 days left. So could we get a big burst back above this 200-day moving average and start to trade around this area? That is possible as we head into this week. But keep in mind what I showed you guys on the longer term weekly and monthly charts is that the bear is still in control. So whatever burst we get in the near term, like we had this burst here, but quickly fizzled out. So we could have another burst here and could do the same thing, quickly fizzle out. So any near-term rallies, you just got to take it with a grain of salt because the bears are definitely still in full control of price action in this overall market. All right, so I think I really broke down the way things look, the way things are shaping out on this by looking at the Dow Jones. Let's just look at a couple of other indices real quick. And I want to stop looking at all the noise because if you guys follow me, you know I really don't pay close attention to the shorter term time frames. Anything below a daily chart, I really don't pay attention to because of my trading style. And those who are going to join me on my live webinar or my live analyzing of the market on Friday, you'll see and you'll learn a little bit more about my trading style. And I really don't day trade, so I really don't pay close attention to time frames below the daily charts, with the exception of just monitoring them to look at some near-term pivot points. So here is a look at the daily chart of the S&P E-minis. And again, we're trading back below the 20-period moving average on this daily chart with price action. Now, I'm trying to threaten a move back up towards this 20-period moving average. The oscillators in the CCI trying to turn up just a little bit. But again, I think this 20-period moving average on the daily chart for now is going to act as a strong level of resistance. Now, the ultimate level that I'm really paying close attention to on S&P futures is right around here where we consolidated in a big way back in December before we got a move up. That's what this line here, this is a strong level of support right around that level. That's around 3,800, folks. If for some reason between now and next week, you look at the S&P futures and you see price action, you know, testing this 3,800 level and break it in a major way, then that's another sign that we're starting to head towards the highs of 2020. So that 3,800 level is going to be a key level, a very important key level to watch over the next week or two on the S&P futures, because if we break that level, probably going to be met with some fierce selling. Okay, that's the S&P daily chart. Here's an S&P weekly chart, and it's definitely showing negative signs with the oscillators and the full stochastics still heading downward. Williams percentage still in a downward fashion. CCI still in a downward fashion, and not even in oversold territory yet on a weekly chart. So that's just showing that the there's more room there's room for price action to trickle lower. So there's space to the downside, folks. By looking at the weekly charts, there's some room to the downside. 20-period moving average, as you see, has come down to meet price. And now price action is trading around the 20-period moving average on the weekly. Again, we break below this 3,800 level. If that happens, then our next level to pay close attention to, if we break below this 3,800 level, next level to keep an eye on, if that happens, would be right around here, around 3,500, right around 35. 3,500 will be the next level to pay close attention to. So we break below that 3,800, 35 to 3,600 would be what I'll be paying attention to within the S&P futures. Here's a monthly chart of the S&P futures. Again, still looks very negative. With the oscillators and the Williams percentage starting to, like it's running into a level of resistance somewhere. It's like it's starting to hinge lower. Also, stochastics got a bounce from that, from the oversold level, but just hanging right in the middle, like it's ready to possibly head lower. And the CCI like it's ready to possibly head lower again as well on this monthly chart. So, and look at and this I really want to point on the monthly chart of the S&P futures. Look how strong the 20-period moving average is as it relates to price action. How strong of a level of resistance it is. When price action dropped below this 20-period moving average, back last year sometime, 2022, it has failed to get back above it on this monthly chart. Tried, but just couldn't do it. So it's like this 20-period moving average on the monthly is acting as a super strong level of resistance. And if we start to see this 20-period moving average bend on this monthly chart, and price action follow, we could see, and if we break this level of resistance right around this 3,800 level, all bets are off. The sell-off will probably really intensify. So that's food for thought. Now look at this monthly chart of the S&P futures. And all the other indices are pretty much right in line. Here's a fake out by taking a look at the NASDAQ futures on a monthly chart. It's trying to defy odds. Everything, it looks like we are starting to turn positive. If you pay attention to the oscillators and the full stochastics, Williams percentage, they're all pointing up. CCI all pointing up. But what I would draw your attention to is what the 20-period moving average is showing us, because that is going to take precedence as of right now, because 20-period moving average and everything's still looking positive on this monthly, on the monthly chart of the NASDAQ. 20-period moving average is keeping a lid on price action. It's like it's starting to bend lower. So what I think is going to happen here is same thing on the monthly chart. We're going to run into that 20-period moving average, and it's going to have some problems. Now, if it doesn't, if we break right through it, and then the 20-period moving average turns upward price, that's a different scenario, but it doesn't like that's what happened. Everything looks like it's 20-period is bending lower. So don't be fooled by just looking at one part of technical analysis. Look at it with a open book, open mind, and with the totality of the circumstances that we are seeing unfold before us, because looking at the bigger picture, it's going to show us with an open mind. Here's a weekly chart. Now, again, on the weekly chart of the NASDAQ, because the NASDAQ has really been one of the ones that's been trying to get out of the basement, but it's running to fierce resistance, folks. We got the 20-period moving average on the weekly chart of the NASDAQ with price action above it. Unlike the others, price action is above it, but there is a horizontal line of resistance that it is struggling. Price action is really struggling to take over. So that's right around, let's see, it's 12,000, around 12,400. So that 12,400 level, 12,400 level of the NASDAQ futures is acting as a strong level of resistance. Unless we see, a huge move to the upside and see, the NASDAQ futures jump out to 12,500 and then, ultimately 13,000. Unless we get up to 13,000, then it's not really showing us, nothing to write home about, because the level has been a strong level of resistance since the beginning of this year, right around this right around this 12,500 level. It's been a strong level of resistance for the bulk of this year. So pay close attention to that. If we see the NASDAQ continue to rally, if it gets up to around that 12,500 level, just be careful, because we could see a strong reversal. Okay, that's a look at the NASDAQ. Now let's take a look at the Russell futures. And it's just showing the opposite. There's a lot of selling pressure on the Russell. It was in a nice upward trend since September. Broke trend right around here where we at now, and now trending below its 20-period moving average and this diagonal line of support, trending below the level now. So the bears are definitely has its teeth dug into the Russell. So any strong rallies again, we're probably going to met with some fierce selling. That's the weekly chart of the Russell. Here's a daily chart. We're on oversold territory, so would not surprise me to see some type of bounce, but where to? Probably right back up to this 20-period moving average, and then get rejected at the 20-period. So pay close attention to that 20-period moving average over the next couple of days or so on all the major indices. All right, now I want to jump to VIX futures, because VIX futures is also painting a narrative. Now, what happened with VIX futures? It's just the opposite of what we're seeing in our major markets. It popped above its 20-period moving average, and now, unlike what we see in our major moving averages, this 20-period moving average is starting to turn upward. See that? The 20-period moving average is starting to turn upward. So now, this 20-period moving average on the VIX daily is going to act as a level of support. So as we see the VIX trend higher, any pullback in the VIX will probably be met with some support right at that 20-period moving average. So I don't think we're going to see VIX back below 22 bucks. That's just my personal opinion. I think we're out of the sub area of the 20s. I think we're going to stay mid 20s, and as we continue to move higher. The VIX is now definitely in some could be in overbought territory. Look at the CCI as we're starting to hinge lower. So but I do expect that the price action in the VIX to remain strong and remain above 2021. So if we see any pullback in the VIX, we're probably going to be met with support right at the 20-period moving average before it starts to turn higher. That's what the daily chart looks like. Looking at our weekly chart of the VIX, it is extremely strong, folks. And look, again, here we go with that 20-period moving average showing you the role reversal as we challenged that 20-period moving average back in December and got rejected on this weekly chart. Challenged it again earlier part of this year, got rejected right back to a level of support. And now look what's happening. We're trading above the 20-period moving average, even on a weekly chart, and it is acting as a strong level of support. So this week we got as high as about 29 bucks. Then we went back to as low as about 22 bucks, and we are holding that level as a level of support. So we got a bounce from that level, and it looks like the 20-period moving average on a weekly chart is even ready to start to turn up. So as long as the VIX is showing strength, the overall market is going to show the opposite. It's going to be pressure on overall market. So that's what we look like, folks. Again, the overall narrative of this market is that the bears seem to be in full control. Now, I'm going to draw your attention to gold, and I want to point out some things that I see in the oil market as well. Gold is looking like it is ready for a major run. Okay. So here is a weekly chart of gold. And this is what gold was doing over the past several months. It looked like it was just forming some type of base for a possible rally or possible breakout. So gold dropped below its 20-period moving average over the past year. Pretty much formed a rounded bottom. Got back above its 20-period. And then at this point, broke back below. Started to pull back. And look what it did. Pretty much just formed what looks like a cup and handle. And rested, price perfect ricochet off a level of support off of that 20-period moving average and starting to turn higher. Look at the full stochastics starting to turn back up. Wins percentage starting to turn back up, and CCI just crossing with a possible bullish narrative or a buy signal, and looks like gold is ready for a move. Let's see how that pans out. But right now, all indications is that gold has formed some type of base for possible breakout to the upside. That's what the weekly chart is showing us, that gold is possibly setting up for a possible big break to the upside. Look at a monthly chart of gold. See the same thing. Oscillators and the full stochastics pointing up, wins percentage pointing up. CCI like is ready to turn up with gold. Looking like it formed a bull flag in the monthly chart. As we are right at an area of consolidation just above the 20-period moving average on the monthly. And the next move, I think, over the next couple of months, we could see gold start to move higher. So if we see that in gold, what do you think about silver? Well, eventually only silver tries to follow gold. So looking at almost the same type of setup. Now, all these lines here, lines that I've been watching gold and silver for many, many years. So I've been drawing these lines, which I am not going to get into right now. But looking at the weekly chart, see almost the same type of setup. Same type of setup with silver as well. Trickle down, beginning part of 2022. Curve back up. Pull back around the beginning of end of 2022. And even though it's trading below its 20-period moving average, I feel like that's going to break because it just formed this little cup handle position. Like it's ready to trend higher again. And you have the full stochastics that's starting to cross back up, turn back up. Wins percentage starting to turn back up, and CCI starting to do the same. So it looks like gold and silver is starting to show signs that it really wants to break out. So any pullbacks in gold and silver was probably going to be a buying opportunity. Just food for thought. Okay. All right. I know this video was long, but I want to show you guys every aspect of what the overall market is showing us as relates to a technical standpoint. And the last one I want to look at is oil, because oil I thought was a setup for a breakout, but boy, was I wrong. It's like oil is set up for a breakdown. And here's a weekly chart, and it actually broke out of this trading range that it's been into the downside. So it was bumping its head up against its 20-period moving average, and then it just got rejected in a big way here recently. And it's strong. This breakdown is strong. So we could see oil prices start to really take a bearish and negative narrative. And what I want to point out is that when that happened in 2020, the market followed. So that's another thing to point out too, is that oil is really starting to push this narrative after it broke out of this trading range to the downside before the overall markets are. We're now trading below 70 bucks a barrel on crude. And we're starting to hit, we're getting very close to hitting where we dropped below in 2020 when we started to sell off in 2020. In 2020, crude oil got to around 65 bucks a barrel, and then it really took off to the downside. And we're getting close to that. So that's a key level to pay attention to this week and next week. Pay close level to the 65 level. If we see crude drop below 65 bucks, folks, it's probably really going to hit the sell. It's probably really going to hit the gas, and we'll probably see our markets follow. So that's something to pay close attention to, which is one of the reasons I did pick up some, I saw some unusual option activity in the XLE, and this is just a bonus, folks. So as we see crude start to pull back, I looked at the XLE and I saw some crazy unusual option activity, and there was some option activity that was dating all the way out to September, June, July, September, looking for price of XLE to possibly drop below 50. When I saw that unusual activity, I jumped right in with some very inexpensive, cheap options, and I'll go over those in my live session on Friday and show you guys what it looked like when I first saw that. But look at the XLE, how it's pressing up against this 20-period moving average on this monthly chart, and it's like it's about to break. If it breaks that, we can see a sharp move to the downside, which is why I do believe that the option activity that I saw is someone taking a bearish bet that we can see the XLE drop below 50 over the coming months. So that's something I'll dive deeper into on Friday. All right, folks, that's all I have for you guys. Hopefully you got something out of my gibberish and my rant, but this is me. I'm down to earth. I'm natural. I say I'm like a ABC trader. I try to make stuff very elementary. So hopefully what I share with you guys today is something that you can use, that you can understand, that is made as simple as possible. And I'm a very simplistic person. But I love using technical analysis just to get a general idea of what's going on in the overall market. So until the next video, Tim Davis is signing off. And for those who are going to be joining me on Friday, I'm looking forward to it. Some live analyzation of the market, and I'm showing you guys a deeper dive into my mindset and things that I like to look at, and some positions that I currently hold. Till then, Tim Davis signing off. Enjoy the rest of your day, folks.